I've seen some remarkable drill results in the first weeks of 2021, and I think we'll have some amazing wins again this year.
It's a very good environment, but it's not a one-way street, and there's a bit of give in there as well as take.
Gold is going to go significantly higher, significantly above 2,500, and in a fairly short order.
Africa is front and center, one of the most important places for the gold mining industry at the moment, and it's going to be moving forward as well.
Welcome viewers to this discussion on gold investment for one-to-one mining investment Africa Online. Today we're going to be discussing gold mining equities and focusing a little bit on the prospect for African mining companies as well. I'm delighted to be joined by a panel of investment professionals who all know how to identify and invest in quality mining companies. So we'll be getting some good insights today. Introducing the panel, it's a pleasure to welcome Jonathan Guy, who is Senior Analyst for Mining Equities at Berenberg, Willem Middelkoop, who is CEO of Commodity Discovery Fund, and Angelos Damaskos, who's CEO of Sector Investment Managers. Gentlemen, a very warm welcome. Thanks for joining me. I just wanted to get straight into this conversation here. Willem, perhaps I could start with you. As we're looking at shareholder expectations at this point in the gold market cycle, your fund's quite unique in that it's discovery stage focused. How do you interpret this industry-wide need for bringing more exploration and development projects online against the difficult backdrop of declining grades and production within the global gold market?
Yeah, I always sell our funds to new investors by pointing out that we could enter a perfect storm scenario in which there's a new bull market starting. We had this bear market started in around 2008, actually 2011. So it took a full decade. Now a new bull market starting, huge demand for the metals, but not enough new discoveries have been made in the last decade. There was underinvestment in our space, and that means that we see more and more tightness developing in many of the metals. We see some production deficits. We have seen that in palladium, which jumped 400%. We see tightness across the board. We see it now in copper and zinc. And as said, that could turn into a perfect storm. And what we've seen in the last few days, of course, is remarkable in the silver space. Silver is a very small industry, but uranium is another interesting part of the industry as well. Also very tiny market caps. And also uranium has been coming out of a very long bear market. So across the board, it's a very interesting point in time, and that's why we can attract quite a bit of new investors. We grew our investor base from 750 individual investors last year to over 1,100 now, and our fund grew from 50 million Canadian to over 160 million. So I think that shows we're in a bear market, and people understand it. And people understand they have to look for hard assets now. So a lot to like.
Willem, would you say this increased investor appetite is coming at it from a sweet spot of, underperforming other asset classes underperforming? Is it an attraction to global gold mining equities, or is it more looking for exposure to a bit of gold? What's the investor mentality for this new wave of investors that you describe are coming your way?
I think the most powerful aspect is the fact that people don't get any returns now on a savings deposit. Dutch people used to save a lot. There's a huge amount of savings. I think it's over 40 billion still in savings accounts, and more people start to understand that if you leave it there, you have a guaranteed loss. So they look for a place to invest. Real estate, is getting rather expensive in the Netherlands. General stocks are, they have a high valuation as well. Of course, bonds are not a very interesting, don't have an interesting perspective for the next decade. And if somebody like me comes along then and shows them that commodities are on a 100-year low valuation, that works in our market. And we service a retail market, high net worth, family office. And I think they see more and more stories in the general press that commodities could have a revival in the next few years, while commodities were very unwanted in the last few years. More and more people are seeing that this could be a next big thing or new thing or revaluation, part of their portfolio.
Yep, certainly. Within your fund and the companies that you're looking at, then coming back to my point around sort of finding companies with good assets and this broader issue of supply tightness, getting quality grades, are you finding that there are fewer companies, or are you finding that actually because of the bull market there are suddenly loads of companies springing up with the next best asset, and you're having to wade through those? What's the sense of making sense of that?
Yeah, we're very fortunate because we focus on the very early stage, the exploration, the discovery phase. That's where a lot of the fun is happening, and we have seen quite a number of new world-class discoveries, especially in Australia. We first neglected Australia when we started the fund in 2008. We started to study Australia really after 2017, 2018. And we benefited last year of some remarkable discoveries there. Greatland Gold, huge world-class discovery in the Pilbara, the Grey Mining, Chalice Gold. So this is a worldwide industry, as you know, and I think too many of our peers are focused only on North America. And I think the companies which do make a potential world-class discovery will be rewarded very much. And it's very tough. It's very hard to find a real strong discovery. That's where all our energy almost goes from our research, the research side of our business. But I've seen some remarkable drill results in the first weeks of 2021. And I think we'll have some amazing wins again this year.
Excellent. We'll come on to the prospects of some of the mining companies in a bit. Jonathan, could I turn to you now? What's the view from your side, from Berenberg here in London? You speak with a lot of investors. Is there more liquidity looking for a home in the gold mining sector at the moment?
Yeah, absolutely. I think that we really saw interest sort of peak at during the middle of last year for gold and silver, and perhaps we've seen something of a rotation into the base metals in recent months as people move from that straightforward trade when things were as bad as they possibly could be as they were at the beginning of the pandemic, with full hard lockdowns across Europe and North America, to people perhaps more focusing on a recovery. But I think if you cast your mind back to the global financial crisis, 2009, 2010, you do get this period of perhaps attention focusing elsewhere. And then when people look at interest rates being longer for lower, quantitative easing, other extraordinary monetary measures and fiscal measures, then people realize that the gold price is likely to move higher again, or to be supported at a high level for a longer period. So the focus we've seen in London is more at the large cap end of the market. People are looking for large liquid stocks that offer good quality exposure to good operators, and we've seen a number of companies taking standard listings on the LSE in the last few months in response to that. So Yamana and Wheaton Precious Metals, and Endeavour Mining has also said that they'll move to a listing over here, which will enable them to get some index inclusion. So yeah, investors are looking for exposure. I think post Randgold getting taken out by Barrick a couple of years ago, there hasn't been that deep liquid exposure that people have had, and so yeah, there's definitely demand in this market for that. In terms of the earlier stage stocks, it's not been such a focus for the London market, but as Willem just pointed out, Greatland Gold up 1,700% last year has been a fantastic performer, and is by any measure a world-class discovery in a tier 1 mining province within 20 kilometres of Newcrest's existing plant at Telfer. So people recognise quality when it's there. I think the market is definitely open for quality stories in the gold and indeed the silver space.
Yeah. Do you think there's still a little bit of apprehension though for the earlier stage stuff, rather than just not, the London, the LSE aim not quite as many companies as the TSXV and the ASX? Is it more a case of London investors not having that exposure to the juniors as much, or maybe they're just a little bit more cautious at the moment?
London hasn't been a pure exploration market for years, and I think the institutional experience in London is much more geared into large stocks, whether it be the diversified miners or now some of the larger gold miners listing here. And there is less experience, less technical experience, and less technical understanding of junior miners and exploration. So whilst you can see a decent retail following for some of the juniors, and particularly Greatland, I think it is a harder market for pure exploration. People want to see, because there is less technical understanding in this market from a geological and mining perspective, and because there isn't a big domestic mining industry, which you obviously have in Canada, in the US, and in Australia. There's less sort of embedded understanding in the market of those early stage technically driven stories. And so I think many investors will say, find a specialist fund that invests in that to do that for me, rather than directly trying to play exploration stories. There also isn't a large number of new exploration stories that have come to the London market in recent years to play that thing.
Yeah. Do you see that changing at all, or perhaps that's just the nature of the market? And
there's an element of chicken and egg there. So I think if investors can see that they can make money out of something, then they will be open to investing in it. And if there's money to be had in London, then companies will look at listing here. I think there has always been a bit of a feeling in London that certainly at the junior end of the market, we end up with those who couldn't raise capital either in Australia or in North America. So we're getting not the first look, but the second or third look at stories. And I think that perhaps it makes it more challenging for some of the junior stories. But look, a good story will always find capital. Yeah.
Excellent. Angelos, could I turn to you now, and perhaps picking up on some of the points raised by Jonathan there, that looking at a fund that has exposure to the junior companies, are you getting a lot more calls from investors that are interested now, or perhaps people that were previously in the last bull cycle for precious metals that are reinvigorating their interest now?
Yes, definitely. I would like to echo what Willem said earlier, that we are coming out of a very long and protracted bear market, where a lot of people suffered material losses from 2011 to 2018, middle of 2019, really, when the gold price started breaking up again. And I liken the situation of the development of a new bull market scenario. The first leg of the bull market is always and typically powered by speculator and specialist investors. People who know the sector, who understand the companies, are able to position capital quickly and are able to endure a very rapid re-rating of share prices. And and this happened largely during the course of last year, after the pandemic correction, the pandemic-induced correction in March. We saw a massive re-rating of the mining equities, the precious metals mining equities, gold and silver equities towards the end of the year. But after September, October, we saw a little bit of consolidation. As Jonathan pointed out, people seem to be rotating into the base metal stories in the hope of an economic recovery and therefore industrial demand for base metals. And we saw a little bit of softening of valuations and prices in the precious metals segment. Interestingly enough, since the turn of this year, we have seen enormous increase in inquiries from more generalist type of investors. People who are generally medium-term oriented in their outlook, are more cautious in their positioning, and they have started looking at the gold mining sector as a whole. Perhaps they had positioned during the course of last year to the more liquid names, the large caps and the mid-cap producers, where they were feeling more comfortable about the balance sheet quality, about the ability to generate cash, and now are looking to diversify the portfolio and move down the market capitalization scale into the smaller, more prospective names, which are typically the growth element of the industry. And this is how I would describe the positioning of our fund, that we are trying to populate it with companies that will provide the medium-term growth in production. And I think it's a particularly prevalent problem among the mid-cap producers at the moment, that they are short of mine life, and they face, many of them are facing declining average grades of mining material. So as they are now flush of cash, they have generated enormous free cash flow with the higher gold and silver prices in the last year or so. They are looking for ways to expand the growth in their portfolio. Now, this is not going to come from new exploration, because this typically takes from 7 to 10 years to bring a new discovery to production. Therefore, we think that there's going to be a lot more corporate activity. They're going to try to buy companies that hold material reserves that can be brought to production very easily and quickly. And we have seen significant activity during the course of last year, but nothing like what we think we will see in the next year or two.
Very interesting. And you think that's going to be across the mid-tier producer range, you think, adding or doing sort of smart, creative M&A that will add ounces to the portfolio?
I think so, because as I said, these companies are now generating significant amounts of free cash flow. Some of them have started paying dividends, others have started buying back stock. The most notable example is Kirkland Lake, which operates one of the highest grade mines in Australia. And they have started buying back stock because obviously they do not find attractive enough opportunities to deploy all that cash. But soon enough, the shareholders will start asking these questions to management teams and asking them, where is the growth going to come from? The management executives are now looking for ways to beef up their growth pipeline. And I think the easy way is to buy highly prospective smaller companies.
Yeah. Do you think then there's a risk that some of the bad habits of the last cycle that are obviously so well documented and talked about, any of that returning? Or do you think that everyone's got enough of a conscious cap on that M&A won't get out of control?
Well, I think we have to see this in the function of where the precious metal prices are trading and where they are likely to go in the next year or so. If we are right in our assessment that we think gold and silver are going to go materially higher from these levels for all the macroeconomic problems and the macroeconomic conditions we are experiencing at the moment, it is very likely that, that some sort of irrational exuberance is going to creep into the markets, and some projects that are perhaps very marginal and too early stage will be bid up highly by speculators. But I think the mid-tier producers and the management teams, I think, have learned some very hard lessons through the long years of bear market, and are now making sure that they have a fairly clean and solid balance sheet, that they don't extend themselves far too much, and they don't buy certainly things that are way too marginal, even at today's prices, so that they don't risk getting hurt if should another downturn arrive.
Yep, certainly. Okay, that's great. So with that then, perhaps we could talk a little bit about where the gold market is going to be headed. It sounds like, Angelos, you're of the view that, there's a lot more bandwidth for gold and the gold price to move on and upwards.
Yes, we think, I think personally that I haven't seen such supportive conditions for precious metals in my career, at least. We have this unprecedented wave of financial stimuli being thrown at the economy by the governments in order to help the economy survive through these lockdown periods and the dramatic loss in GDP that we have suffered over the last year or so. And ultimately, a lot of that liquidity is creating some bubbles in the market. We see it everywhere. We see it, with some stories we can talk about later in the market of companies being far too overrated in relation to their fundamental value in the markets. But at the same time, investors realize that with all this liquidity being pumped into the system, the main currencies in the world are going to be debased. They're going to lose monetary value, whether that is due to straight feeding through to retail price inflation or through the sort of stealth inflation that we see in various asset classes, is another question. But ultimately, the money in this world is losing purchasing power. And at the same time, we experience historic lows of interest rates. And the central bankers will be unwilling to raise interest rates anytime soon for fear of damaging a fragile economy. So these are the classic conditions to propel precious metals higher in value. A lot of liquidity that potentially could creep into inflation and persistently low interest rates. So I think gold is going to go significantly higher, significantly above 2,500 and in a fairly short order. And silver, we already see today, is up over 10%. Silver is naturally much more volatile than gold and has a propensity to outperform in a bull market cycle. So this is what we are experiencing now.
Yep. Willem, could I come back to you and get your view? Obviously, you're bullish on the sector, but do you share the same sentiment as Angelos that we've got a long way to run on precious metals prices?
Yeah, well, I'm one of these boomer gold bug guys who started advising to add gold to your portfolio already in 2001 and 2002, and that's what I did myself. Was a private investor at that time, was a journalist at that time. And I always said one day we could have a situation where gold will run to, $5,000, $8,000 based on historical norms. You could say the next bull market, before all is said and done, at least $5,000 will be reached. I always have said that. And of course, there are other experts who call for 10 or 20,000. But I always say to our investors, let's first reach 2,500, 3,000. You'll make hundreds % of returns when we reach 3,000. But I'm quite sure, as Angelos just said, we have the perfect conditions now to have a huge bull market in gold, especially gold, since all currencies are debased. And it's a no-brainer now. It's only a question when that will happen, not if that will happen. We already crossed the all-time high of 2011. We had a nice technical correction now. Once we break through 2,100, which will happen, I think, within the next 6 months, it will be a quick run towards 2,500, maybe even 3,000. And in the next few phases in which inflation will start to hit us, central banks have communicated they want to see inflation. They want to make up for lost inflation, so they're moving towards 4 or 5% inflation, and I think they will have it. Look at what's happening with the soft commodity price in recent weeks. Look what happens with the grains and the soyas. They're going up limits day by day, and so the outlook for especially the gold industry is better than ever.
Yep. Jonathan, can I turn to you on? Do you have a view from Berenberg in terms of gold price outlook or precious metals?
Yes, I mean, look, I probably take a slightly more cautious view on gold price outlook, whilst agreeing with the overall thesis. I think that there is going to be exceptional monetary policy out over the medium term, and that will be very supportive for gold and silver prices and hard assets more generally. I think governments' balance sheets are in a reasonably awful state, and they're not going to get any better anytime soon, and that is good for hard assets across the board. I think there is a different question about how does that play out for the equities. What we saw in the last cycle and what we'll see in this cycle is a period when the precious metals run very hot, and there are sort of supernormal returns to be made from investing in them. But that doesn't happen in isolation. And if you're calling for $2,500 an ounce gold or $5,000 an ounce gold, then you're also saying that inflation will probably be very high, that governments will be in a bad way. And when governments are in a bad way, host governments across the board, they will push up taxes, they will push up royalties. As we've seen over the last week, as people start reporting, labour inflation is beginning to come in, because when workers at mines see that the company is making $1,000 an ounce all in sustaining cost margin, they want a share of that. Governments, as I said, will put up taxes, put up royalties, input prices, steel prices will rise, other metal prices will rise. And so, yes, you could say much higher gold prices, and yes, that will be positive for the equities over the short term, maybe over the next 18 months. But there is a catch up there in terms of taxes rising, royalties rising, governments wanting a bigger share of the pie, workers wanting a bigger share of the pie, and inflation in terms of all the input prices that go to extract an ounce of gold as well. So it's a very good environment, but it's not a one-way street, and there's a bit of give in there as well as take in terms of margins on ounces produced over the next 2 to 3 years.
Yeah, certainly, that's a very good point, and perhaps I could dig into that a little bit deeper in terms of making sense of the good mining companies as an equities investor. It's obviously easier with the gold price wind in your sails, but it's surely on a case-by-case basis of how well the companies are doing. How have you seen them performing across the majors down to the juniors?
Look, I think if we look at the gold mining equities at the moment, they're in a much better state than they were at the end of the last cycle. There hasn't been the type of overpriced speculative M&A that we saw. So where there has been M&A, it's generally been sensible. Northern Star merging recently is entirely sensible. Where we saw Barrick and Newmont combining their assets in Nevada, that was entirely sensible. So I think we're seeing pragmatic M&A at the moment rather than overpriced M&A. Most people have balance sheets who are in a pretty good state. People are moving from net debt positions to net cash positions. There is a lot of pressure from investors, which management teams are feeling to pay out more to shareholders in the form of dividends. Very positive news from Kirkland Lake over the last few days in terms of the amount of money that they've been returning to shareholders. So I think the industry is showing much greater discipline than we've seen previously, both in terms of M&A and in terms of balance sheet management. And I think it goes into this cycle or goes into this phase of the cycle in a much better position than it has been in for the last 10 years. So I think management teams have actually generally done very, very well in the last 3 or 4 years after a few very, very challenging years between 2012 and 2015.
Do you think that's factored into their share prices at the moment? Do you think that there's still a lot of value out there in terms of companies sort of being undervalued, perhaps?
I think it depends on where you're looking. I think certainly some of the Australian equities had a very, very strong run up early on and were perhaps looking a little bit expensive in terms of investors were, I think, looking at it and saying what we want is pure gold price exposure. So we don't want any of the political risk. We don't want any of the security risk. We don't want any of the regulatory risk. So investing in well-run Australian gold mining business was a very pure way to play that gold trade, obviously supported by a weaker Australian dollar. I think you're now seeing a phase in the cycle where people have to look to perhaps somewhat more risky geographies to find stories which are still undervalued, because those which are well understood in low risk geographies have been very well rewarded. Well, seen a big uplift in share prices already. So I think people have to cast their net a bit wider and cast their net a bit further down the production chain. So look for those stories which are either advanced exploration or completing feasibility studies, bringing projects into production at this point. Where the value is has perhaps moved on a bit.
Yeah, certainly. Angelos, could I ask you about valuations? Do you think companies are fairly valued at the moment, or do you think there's a lot of there's been a re-rating amongst some of the majors, but perhaps the juniors are still undervalued?
Yes, I tend to slightly disagree with Jonathan in terms of the broad valuation of the sector. I think the broad sector, including majors and juniors as a whole, is still a little bit undervalued in relation to where the spot prices trade at the moment. It is surprising that investors have been unwilling to assign a full valuation to the sector, given the trend in metal prices. But the undervaluation is far more pronounced in the smaller capitalization segment of the sector, because people have been reluctant to allocate risk into that sector. The smaller cap segment is always perceived as a more risky, much more volatile. It certainly is less liquid. And we have seen relatively smaller interest, which really started in the middle of last year. So I think as we continue the development of this cycle, and with the recent consolidation in prices, as I said earlier, from September to the end of the year, it gives opportunity to a greater sort of spectrum of investors to step in and look at the sector and perhaps increase their allocations and hopefully re-rate the valuations to where they should be in relation to the spot prices. There has been a little bit of cautiousness and reluctance among the generalist investors, not having clear visibility of the commodity prices and being a little bit also cautious. But now with the recent moves of precious metal prices back again towards the recent highs, I think there's a greater optimism and more willingness to look at the smaller, more specialized names. So I think, compared certainly to other segments of the market, if you look at the technology sector, if you look at biotech or even some of the more diversified industrials, the valuations of the precious metals miners, if you look at the producing companies at least, are still way too cheap.
Good. Yeah. Okay. We've got about 10 minutes left. I just wanted to move on to a couple of other points around what's going on within public markets globally at the moment. And maybe that ties into some of the points covered around valuations as well. I don't want to dwell on the GameStop saga specifically, but certainly the fact that it's now touching into junior mining companies and also the silver market. Willem, I wondered if I could bring you in here around what's your interpretation of this sort of fundamental change in how retail investors can influence markets and how they can rally themselves. Do you see this as something quite short term, or is this fundamentally an evolution of how they're going to be looking at investing? And what does that then do for the junior mining company that's exposed to this extreme volatility?
Well, I see myself as a student of monetary history, and if you put this in a historical perspective, once a large part of the general public starts to speculate on stock markets, that has always coincided with the last phase of a very long boom market. It happened in the 1920s. It happened in Weimar, Germany in the 1920s. So I've been a market commentator for Dutch TV for 10 years. And I always said, as long as this network exists, as long as CNBC exists and we all watch it, you can end up in a very scary boom market, which could lead to a very, very severe downturn or even crisis afterwards. We've seen so many of these examples in history. And what we see now with the younger generation storming the stock exchanges in a revolutionary way, it's almost like an attack on the Winter Palace in St. Petersburg in 1917, but then with digital means. And it's a new generation, and they really want to break things down, like the crowd in Washington wanted to break things down and ended up fighting within the Capitol. So these are revolutionary times, and I always like to place these developments in a much broader perspective. And well, actually it scares me. And today I will benefit because we're 20%, almost 50% of our fund is in silver related equities, and the whole portfolio will do well. and last year we did 85% return, gross return. But it scares me because it's all the end phase of a much broader bull market. If you look at from a technical point of view at the Dow Jones or the Nasdaq, you're in a blow-off top situation, and we all know how parabolic moves end. So that more, on a more philosophical note.
Yeah, it's interesting. Thanks, Jonathan. How does a stock picker make sense of what's going on at the moment? Do you ride this out? Is there opportunity to be had here?
I think from a stock picking perspective, you don't try and make sense of it. You just ride the momentum and work out who are the leveraged silver plays and ride them up off the back of it if that's what you want to do. And you can whether it be First Majestic in North America, Mag Silver, Fresnillo, Hochschild, Wheaton Precious Metals, then all of them offer good listed leverage to silver prices. So if that's what you want to do, then that's the way to express that trade. I don't think this is fundamental investing because it's being driven by short-term market moves rather than anything else. And really, we need to see where the metals are in 3 months or 4 months, and I think you can perhaps then start to take a view on whether to start moving long-term prices and long-term net asset value assumptions that you would make in terms of valuing companies. But clearly it's positive over the short term for people's earnings. It's positive over the short term for EBITDA, which will drive all those short-term multiples that people use to evaluate these companies. But long-term implications, it would take a while for silver to maintain at these levels for me, or I think other fundamental analysts, to want to start looking at changing commodity price decks. I mean, silver's been like this before. It rallied very briefly and very hard in the last cycle. It rallied very hard in 1980 when the Hunt brothers managed to corner the silver market. So this isn't the first time this has happened. But on previous occasions when this has happened, it has been reasonably short-lived. So as I say, enjoy the party, but dance close to the door, because when we reach the end of this, then it can unwind quite quickly.
Yeah.
Can I react on that, please?
Yeah, please.
Because we always hear this. We always hear these kind of comments from industry experts, especially from the city and also from New York. But they never tell you that the total world physical silver market is 20 billion a year. That's less than 1 day QE of the Federal Reserve. And I'm not talking about the money printing of all other central banks. There's 400,000 billion of debt slushing around. If only 1% of that money starts to flee to hard assets like gold and silver, and the Reddit crowd, they understand, then the silver price, like Eric Sprott, which I see as my mentor always said, the silver price can jump from this level to $100 within a week. And I think we'll run much higher. So it's way too easy to always say, this will end in tears. We've been here before. They will burn their hands.
But we have been here before, and it did end in tears.
Yeah, but we never had 400,000 billion of paper money being printed. A quarter of all dollars in circulation was printed in the last 12 months. And the younger generation understands, Jonathan, the younger generation understands you have to flee to Bitcoin and out to silver. And this is only the start. It's a revolution. The Winter Palace, they thought that they would go away. You shoot in the air and it will run away. Well, a week later, they were fleeing into the Siberian desert.
What about silver equity?
And as a counterpoint to that, those fleeing into Bitcoin a month ago at $40,000 plus are now nursing 30% losses. It's volatile. That's my point.
Come on. It's not on the short term.
Can I just add to the commentary here that I think I agree to a certain extent with both Willem and Jonathan, that it is a trend and it is something that could drive a speculative mania and could drive prices at previously unthinkable levels. But I think the dangerous situation with this trend is that the Reddit crowd seems to be of relatively low sophistication. They follow some kind of a tip mentality over the web and the chat rooms, etc., where they egg each other on to bid prices higher and higher. And I think this is the dangerous aspect of this particular trend, that there will be absolutely no regard of valuation or prices. For example, we see today one of the largest silver mining companies, First Majestic, up 25% pre-open. And it is that's a $5-6 billion Canadian market cap. I mean, it's a significant volume of trading behind this trend to push these prices 25% up. And I think the crowd sort of mentality of this generation or of this attitude is the dangerous aspect, because it distorts the opinions of the more sort of specialists or more seasoned investors like ourselves. We get drawn into it, and we all sort of fuel the market in one way or another. And there will be a lot of volatility. You know, we may go up to $50 an ounce for silver and come back to 30, go back again to 100 and fall back to 70. Some people will buy at the top and will lose money. The long-term investors who believe that the precious metals are gaining because of the long-term macroeconomic investors are the ones who will gain the most, because they keep their positions, they stay steady, and they hold for the whole pattern, the whole picture to emerge over a longer period of time, rather than play the day volatility and the weekly volatility in stocks and try to catch the peaks and troughs. And we all know that no one can do that perfectly, and no one can do this consistently. So the answer is to really stay the course, believe in your trend, believe in your positioning as a medium-term investor, and then ride the speculative activity as it happens.
Thank you. Yeah, that's great. Okay, well, with the last discussion point then, I wanted to frame this a little bit towards the fact that this is going to come under our one-to-one money investment Africa event, and we should all really be in Cape Town right now. So looking at the African continent then, the resource potential and the amount of reserves that the huge continent holds, do you see a future for more gold mining and greater discoveries in Africa? West Africa, for instance, has had some great success stories of late. It's proving a great jurisdiction for mining, but maybe there's still some concern from investors around allocating capital to these areas because of jurisdictional risks. What's the panel's view towards some of the opportunities that mining projects in Africa could represent to the precious metals sector? And I guess if we just go around, Jonathan, if you have a view at all.
No, I think if you want to find gold, you have to go to where gold is, and that's not always the easiest part of the world. And if you look at West Africa, if you look at the Congo, if you look at whether it be Egypt or Tanzania in East Africa, that Africa is front and center, one of the most important places for the gold mining industry at the moment, and it's going to be moving forward as well. The problem is can you maintain fiscal and regulatory and security regimes that allow you to build and operate mines? And obviously we saw the issues that Barrick had in Tanzania a couple of years ago. We've seen the security issues in Burkina Faso in 2019 that resulted in, I think, 40 deaths and others going missing in Burkina Faso when Semafo was had a convoy hijacked there. We see a degree of regulatory risk as well across the region, and problems with taxes and royalties. But the Birimian of West Africa, the Congo Craton in Central Africa, this is where gold is. These aren't the easy places to go, but these are the places where there is still gold. So if you want to explore, then absolutely that's where you've got to be. And most of the world's large gold mining companies have a presence in Africa, and to me, it's front and center, one of the most attractive places to be exploring for gold at this point.
Yep. Excellent. Willem, could I turn to you? I know you're traditionally more was Canada and then Australian focused, but what prospects do Africa or Sub-Saharan Africa hold for you and your fund?
Yeah, we always had a focus on Africa as well, although we don't feel comfortable with each and every country, as Jonathan has pointed out well. There are certain risks there, but that's also why valuation is often cheap. But we focus on the discovery side. And if I look at the discoveries being made in the last 12 to 24 months, a few names come to mind. Roscan has a great project, predictive. Osino, of course, in Namibia. Sama Resources, that's nickel in Côte d'Ivoire, Ivory Coast. So there are some very, very interesting situations which we follow closely. And in all of those mentioned names, we have built positions and we do private placement. So I think Africa is a very, very interesting situation, and more M&A can be expected there. And I think in general, of course, there are a few countries with security risk, but on average, I think the security situation and political situation is stabilizing after, some very bad decades in the past. So I think you should look at the West African and other African situations and projects and companies as an investor.
Yep, certainly, and it's a good point. Perhaps so. It's wrong just to say Africa generally. It's very much a country-specific approach needed.
It's not a country, it's a continent.
Yeah, indeed. Angelos, do you have a sort of a regional preference within Africa, or is it country by country for you?
Yes, certainly I fully agree with my fellow panelists that Africa is to be seen, it's a great continent for commodities for a start, and massive exploration success has been achieved in Africa over the centuries, but not every country provides a fairly comfortable and safe enough background for mining investments. So we tend to concentrate on the more stable jurisdictions, the likes of Ghana, Côte d'Ivoire, and the countries that offer more stability, a better understanding of the regulatory regime, and also better rule of law. For example, we have avoided consistently for the last 4 or 5 years South African investments because of the instability there, even though it is, one of the most advanced economies in the continent. But we are very careful with the jurisdictional risk in our investments, and this is a principle we have applied over the years in our strategies. So the majority of our exposure is North America, Canada, the United States, followed by Australia. And then the next bigger component is Latin America, particularly Mexico for silver investments. That's the silver country. And then Africa really is the smallest exposure in our portfolio. And we are being quite selective in terms of the quality of the project, the quality of the teams, as well as the quality of the jurisdiction. But in recent months and years, I think there have been some remarkable success stories in Africa of projects getting mobilized well within budget and time. For example, West African Resources has been a particularly successful example of bringing a project to production a lot quicker than we anticipated. There have been some other success stories like Teranga Gold, developing from a very small base of resource to being a multi-asset company, and then ultimately merging with Endeavor recently. So it is a region or a continent, I would say, that is maturing, and the local government and the politicians understand that mining is a very important component of the economy and they ought to support it. So it's probably a preferred industry, I would say, in the African continent as far as the industrial spectrum is concerned.
Yeah, certainly it would tie in with the growth story narrative, I suppose, for a lot of African countries looking to get back to positive GDP after the pandemic fallout as well. Okay, well, look, gentlemen, that's taken us to time. Thank you very much for your thoughts today. We've covered a great deal of ground and made a lot of sense of some of the craziness going on in the equities markets, and also looking at how to assess precious metals equities in this current climate. So thanks very much to Willem, Jonathan, and Angelos, and hopefully see you all again quite soon for something online.
Thanks very much, guys.
Thank you.